The Bank of England surprises with a second vote, but can a divided House stand to keep cutting? The Bank of England had a tough time getting on the same page on Thursday. The UK Central Bank cut interest rates the lowest in over 2 years, but for the first time in its history, it had to conduct a second vote to decide. Governor Andrew Bailey called genuine uncertainty on its next move, and the prospect of another reduction this year is now shrouded in doubt. Paul Hollingsworth is head of developed markets economics at BNP Paribas. So, Paul, what's going on with the UK economy that's causing such division?
Well, I think the first thing to say is that there is a considerable amount of uncertainty about the outlook. And so high uncertainty is a ripe environment for different members of the MPC to take differing views. And fundamentally, it comes down to a tension between, on the one hand, the stickiness that we're seeing in inflationary pressures, and on the other hand, the weakness that we're seeing in the labour market. And so these divisions are representative of the different weights that different members of the MPC place on those downside risks in the labour market and the upside risks to inflation.
Let's look at inflation first in the UK. It's well above target right now. So why are some members opting for a cut?
Monetary policy acts with a lag. So if you wait until inflation is back at 2% before you cut interest rates, then the risk is that you actually undershoot. So it makes sense that members are voting to cut when policy is already restrictive right now. The other thing to point out is that the MPC sets policy with a medium-term view in mind. So it's really caring about where inflation is in 18 to 24 months ahead. And on the MPC's forecasts, they do have inflation getting back to 2% within that time horizon. And that is based on the market's expectations for rate cuts going down to 3.5%. So it makes sense that they are continuing on this path of further rate cuts. But I think we are getting to a stage where there is now a little bit more of a concern about how quickly the MPC cuts from here and whether that is a bit more balanced now of perhaps going a bit too fast versus a bit too slow.
Well, let's talk about that pace. Are more cuts coming this year, or do you see growing divisions to prompt a pause?
We still think more cuts are coming. We have one more cut in November for this year, and then one additional cut in February next year. So we think that the terminal rate will be 3.5%. But we think the risks are skewed towards a slower pace of cutting. And in particular, we think there are two things that the MPC is going to be focusing on. The first thing is evidence on the supply side of the economy. So if we start to see further evidence that the supply side is weakening, that might be a concern when it comes to inflationary pressures. And second, inflation expectations. So the Bank of England expects inflation to pick up, as do we, over the next few months. They see a peak of around 4% in September. Their base case is that this proves to be short-lived and that we don't see any persistent effects. If, however, we see that consumers are updating their expectations in an upward direction, then the BOE might be more concerned about that, and that could prompt them to slow the pace of rate cuts. I would say a final piece of evidence they will be looking for is fiscal policy. What happens at the next budget? And if, as we expect, we do see a little bit more in terms of fiscal consolidation announced, then that would actually support the case for further easing.
Another worry for the BOE was its long-dated bond sales. They risk straining the gilt market further. What does it mean for its QT decision in September?
Well, our long-held view the BOE would take action to try and limit the impact that QT is having on the long end of the yield curve when it makes its annual decision on QT in September. I think what we heard at the meeting this week very much supports that case. So I think a reduction in the QT envelope is all but certain. The question is really to what level, and we see it as a pretty finely balanced decision between, on the one hand, our base case, which is a complete stop to all active sales of gilts. On the other hand, they might decide to just have a reduced envelope. So if the BOE did nothing, if they decided to keep the envelope unchanged at 100 billion, that would imply quite a significant increase in active sales next year. We think they will want to avoid that. So we think they either stop altogether or they set the envelope so that they keep active sales around the sort of current level. That would imply a total QT envelope next year moving down from 100 billion to something like 60 to 65 billion. And it's possible, in addition to that, that the bank executive decides to skew the sales away from the long end of the curve, also to help try and alleviate some of the pressure that we're seeing.
So finally, Paul, the Bank of England's more hawkish turn yesterday lifted the pound. Does it have further to go?
We think it does. We think the pound can appreciate further against the dollar, and we're looking for it to reach 138 by the end of this year. But it's worth saying that we see less scope for sterling to appreciate than other G10 currencies against the dollar, where there is perhaps more arguments to be bullish, for example, when it comes to the euro, given that we are seeing a bit of a divergence on the fiscal front with more fiscal spending in Europe, which is helping to boost sentiment, whereas in the UK, the prospect is actually for a bit more fiscal tightening over the near term. So still bullish when it comes to the dollar, but to a lesser extent than for some other countries, some other currencies.
That was Paul Hollingsworth of BNP Paribas. Don't forget, you can watch more videos on Reuters.com.